Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I'm your co-host, Jerad Lee.
And it's our first news episode of the year.
But who are you?
I was going to say, I should probably introduce myself too. I'm Ben Rose.
For those of you who don't already know.
Regular other co-host that isn't Jerad with the English voice. For those of you not watching us in awesome video, live in person this time.
In person. For the news.
Yeah.
Which is...
That doesn't happen often.
No. We have some time in the studio. We figured end of the month, let's smash into the news. So without further ado, here we go.
Yeah, what's going on right here, right now, all around us?
Well, right here, right now is severe weather zone London.
Indeed. Who would have thought that a rogue news presenter journalist was able to say that they think it's not even a hurricane, Storm Isha, or Ishmish, as Jerad has been calling it, is currently, I think they said, currently the most powerful storm in the world.
Yeah.
So for some brief moment, apparently the UK was the stormiest place on Earth.
Yeah.
But that's a claim you could probably make.
Yeah. I mean, if you look across London, wheelie bins adrift, branches on the pavement.
Hairstyles knocked out of sorts.
Yeah. It's been wild.
Stray cats are stray.
But if we stay on the sort of major event sort of space, there's this piece that came out in the Insurer that was talking about sort of, are we ready for the next major volcanic eruption? Because we had 6 years ago, the Icelandic one, which was massively disruptive to like the travel industry and huge amount of losses that came from that as those ash clouds sort of shut down huge swaths of travel across Europe. But they're sort of diving into, one of these feels imminent now, doesn't it?
So there's a funny word that I've forgotten, but I did learn about recently. And it comes in two types, the upward version and the downward version. But it's an interesting word. Anybody can email us and tell us what this word is. But basically, when a volcano goes off, either it can send stuff up into the air, or as we saw in Iceland, a couple of weeks ago now, it can come down the mountain instead. And they have the same name, but one is the upward. Like
stalactites and stalagmites.
Yeah,
for those of you who are
that kind of
cavers, or whatever caving.
But it's like a really oddly technical word. Anyway, we are seeing a lot of volcanic activity around the world. Lots of seismic kind of movements that suggest potentially an eruption could come at some point. But then again, where we have seen those happen historically, it's been like, oh, well, it did wobble slightly 30 years ago, so that eruption was due any minute. Yeah. So, bit of discussion in the press this month about whether the reinsurance industry is actually prepared for such an event, should one occur in a busy area. Yeah,
well, and going back to your previous article we talked about before about like this idea of gray swans, a volcanic event, it could be a massive cat, but it would seem to be more like a very large gray swan event. And sort of the other piece that's coming out is looking at 2023 in hindsight now, more than 123 billion in insured losses. But as we've talked about, no major cat events. A lot of this is driven by sort of severe storm aggregate losses in the U.S. This could continue to drive that kind of moderately large events that just accrue to the detriment of the industry in many ways.
Just like the largest storm on Earth in the UK, just adding to that bill. Speaking of bills, I mean, I know I'm jumping the order, but there is a bill in the US.
We'll jump the order. It's
completely messy. But too good a tangent to miss.
It was an excellent tangent. You seized it appropriately. The Federal Reinsurance Program bill sort of was brought to the floor in the United States to some insurer skepticism this time around.
Yeah, I think there's this long recognized challenge of affordability of reinsurance for insurance companies, who in turn have a lot of constraints as to being able to charge sufficient premiums to at-risk policyholders who have a lot of disaster exposure, whether that's wildfires and earthquakes in California or hurricanes in Florida, etc. The solution to some of those perils historically has been localized, like state programs. So you look at FHCF in Florida, you look at the NFIP for the flooding. Some of those schemes have gained quite a lot of debt, should we say, and are seen as maybe not as successful as one might hope. And I think the response, therefore, to the idea that we should have one of those at a federal sort of US-wide level, and possibly that in itself resulting in the dissolution of the others, has not been met with the warmest reception,
Yeah.
because people have thought, well, it doesn't work on a small scale that well.
Yeah.
So why would we make a massive one that is out of sync with the private markets at a time when the private markets are kind of recovering, and getting a bit of momentum? So people have started to question that, I think.
Yeah, and I think rightfully so. And this would be interesting to bring someone on to do that does policy in this space. But there's also some conversations this week in the UK around building a cyber program similar to like Flood Re, and the sort of push that it should operate in a similar sort of function. But Flood Re is supported by the government, where these sort of pushing this effort to push this forward would be broadly independent and aligned with sort of market conditions, but this pursuit of there should be an aggregate pool of protection for these types of things. So the interplay between the regulators and governments and these sort of supported schemes alongside the sort of independent market is always an interesting one to sort of wrestle with, isn't it?
Absolutely. They have tried to add some pizzazz to it by giving it an interesting acronym. The US federal scheme has somehow managed to achieve all 7 letters.
Yeah.
No. Yes, 6 letters of insure. It's 6 letters, isn't it?
Yeah.
I had to think about that.
Yeah.
In its acronym, Intergalactic National something or other. Insurance something or other. But basically, game on. And if you're somewhere else in the world and you want to set up a pool or a scheme, it has to have an interesting acronym.
Well, good luck getting the domain name, though.
This is true. This is true.
Going back to the original scheduled order of the news today, a bunch of reports as well, wrapping up 2023 as these things come out, is really strong performance in the ILS space, to be reflected in European reinsurers. This is sort of JP Morgan coming out with this. And then alongside Swiss Re sort of securing a $50 million cyber retro ILW. So that part of the industry sort of getting continued momentum around alternative capital and things.
Yeah, and we had a really good conversation in our renewals recap episode, so I won't repeat too much of that here. But one thing that had come out in the press recently, I think on Bloomberg or similar, front page news, was that some of the top performing hedge funds this year had disproportionately gone heavy into natural catastrophe exposure, which worries me slightly, that they're going to get the wrong end of the stick and think, oh, that's the place to be, when looking at the results of any kind of fund that's going the catastrophe exposure route on a 1-year basis. Not the way to measure performance.
I'm putting all my chips on
exactly.
Black 8.
So much money. It's like, you need to look at this over a slightly longer return period to know whether it's a good idea or not. But hey, it was a good idea last year. I mean, who knows? Maybe they won't stick around. Maybe they're like, great, done.
Sample size of 1. This is printing money.
Yeah, we'll stop there and off we go.
Yeah. Speaking of printing money, reinsurers continuing to enjoy attractive market conditions, despite the sort of momentum slowing a little bit there, which we talked about in the 1/1 recap. But it's still a place to be. There's been a number of deep dive sort of articles around, even as reinsurance market conditions, or those opportunities are beginning to sort of plateau, it's still a far more attractive space than the other options available to the insurer. So it will continue to be the sort of primary source of support for the insurance companies, and therefore an attractive space for the reinsurers right now.
Yeah, absolutely. I think despite this grey swan environment that we've discussed a lot, things feel relatively stable across the board. Yes, there's like a bit of fear at the moment that with what's going on in the Red Sea and with the Houthi rebels shooting at trade ships and so on, that shipping might be a lot more expensive and trigger a rise in inflation again. But they're not comparing it to anything like we saw in the pandemic, where it wasn't a case of it's taking longer to get stuff. It was a case then of you just can't get stuff at all. It was fully blocked bottlenecks. Whereas now it's just sort of, we've got to go the long way around. It's more expensive. Maybe that'll slow down recovery of interest rates to target levels, but we're not really likely to see a big economic change as a result of these various conflicts or challenges around the world.
Yeah, for sure. And then lastly, wrapping up the news on the month is sort of a return to technology focused. Supercede, a company we know well.
Who's that?
The Reinsurance platform. Massive jump in usage, 43% increase in platform-wide usage to end the end of the year. So it's super exciting news for us and our team on that movement. But this broader shift towards this recognition that the industry is still not investing as much as expected in technology. But we're seeing that begin to change. One of our integration partners, Hyperexponential, just closed a large Series B funding round as well. So you are seeing that movement and that commitment to technology beginning to grow. But I think the industry talks a bigger game than it's delivering at the moment, aren't they?
Absolutely. I think we had a conversation this morning on a separate panel with the chief economist for a large bank and a bunch of other firms talking about AI. And not that it was necessarily catching the interests for normal tasks in insurance companies, but it was at least for these big enterprises lifting the bar and sort of saying, okay, now to be good at technology, you've got to be here. And as a result of that, the bar of being bad for technology is lifting as well. So there's an opportunity to be still perhaps behind, the best in class. You're not like in the space race. But you also don't want to be in the worst in class and be behind when it comes to having clean data and having good insights about your portfolio and the business that you're doing. And I think the insurance industry has had a bit of a shake-up in thinking, oh, hang on, if the cutting edge is now that much higher than it was, then we still want to be like acceptable laggards, not healthy laggards, and not like kind of really, really inescapably far behind.
And we've always sort of seen this, right? The table stakes increase, and over time you're expecting that. Like there was at one point the last insurer who sent their submissions via fax machine. Right. And eventually they're like, okay, next year we're doing emails, right?
So this is getting out of it.
You're always going to have an element of that natural progression upwards. I think the excitement with that sort of step change, which we've seen more recently with the sort of push of AI, whilst I don't think it's going to transform this industry overnight, is sort of dragging people up a bit more to, okay, we need to have at least shifted to knowing what is in our book of business a bit more, So those types of things are happening. So optimistic that the market will continue to invest and lean into that future. We're seeing it certainly on our side. So exciting stuff ahead.
Indeed.
But there you have it, the news for January 2024.
We'll see you in February, folks.
See you next month, everyone.